Now, the first suggestion would be to stay with the trend. And if you ever follow any of the work I do, I love to use the double Bollinger Bands, which are the 20 period, 2 standard deviation Bollinger Bands, 20 period, 1 standard deviation Bollinger Band. And let me actually apply this to a live Eurodollar chart. Okay, so we got rid of the Dow. I'm going to apply my Bollinger Bands and show you why it's so important why I think that it's important to stay with the trends in a volatile market. Because the market gets into one sentiment or one line of thinking for a reason, and usually stays with that line of thinking until there's a reason to change. So I'm just going to set up my Bollinger Bands real quick here just to show you what we're looking at on a technical basis and how you would stay with the trend in volatile markets. So that's the default Bollinger Bands. I'm going to add in the 1 standard deviation Bollinger Band. Okay, just give me 1 second and we will be all done. Alright. So, I've got my Bollinger Bands here, and the way to use the Bollinger Bands is I like to say, as a rule of thumb, when the currency pair is in a strong trend, it usually likes to remain, mostly in the 1-2 Bollinger Band. So we see that here. The Eurodollar is in a strong downtrend if it remains in the 1-2 Bollinger Band, the downside. And I like to say that it's in a strong uptrend if it remains in the 1-2 Bollinger Band, the upside. So you can see that the Eurodollar is in, a pretty significant downtrend. And I think that that's pretty important because given that it's in this downtrend, it tells us that there's more scope for losses than strength. So in this case, one of my tips for trading in the volatile markets, or at least what I would do, is I would stay short the Eurodollar in this case until it closes outside of the 1-2 band. So in this case, I would remain short, and it could very well do this because we're so close to the first standard deviation Bollinger Band. But I would stay short until the Eurodollar closed above 136. And that would be the only time when I would actually turn bullish the Eurodollar. In terms of how do I make the middle line disappear, I just unchecked it on my trading screen. Now, the next tip that I have for trading in volatile markets, let me go back to my slide, would be to trade ultra short term. Because one way to trade the markets would be to trade ultra long term. Because if we traded ultra long term, that would basically kind of help us or help shield ourselves from some of the crazy intraday volatility. And if we traded ultra short term, that would allow us to focus on really, really kind of brief movements in the market. So one way to consider trading ultra short term would be to let me move my slides to the next one. It would be to use something along in the lines of the extreme fade. So what the extreme fade is, and let me advance my slides. The extreme fade basically also involves using Bollinger Bands. And because if you ever see the work that I do, I really, really love Bollinger Bands. So with the extreme fade, we, instead of using the second standard deviation Bollinger Band and the first standard deviation Bollinger Band, what we use is the third standard deviation Bollinger Band and the second standard deviation Bollinger Band. So the reason for this is because it really helps us capture the really rare movements in the market. So what we want to do is we want to put the Bollinger Bands in our charts, and we want to add the ADX. Now, ADX is not a complete necessity, but I just like to have it on there, and I think it's quite helpful. But I like to add in the ADX, and I only take the trades when the Bollinger Band goes from the third standard deviation area when the currency pair touches the third standard deviation Bollinger Band. I'm actually on the slides right now. And what I want to do is I want to watch the currency pair close at or above the third standard deviation Bollinger Band, which basically looks like this. So you wait for the currency pair to rally. You want to watch it close at or above the third standard deviation Bollinger Band. The reason why this is important is because we get into a really extreme move when that happens. So we see that the currency pair closed at or above the third standard deviation Bollinger Band, but you don't take a trade simply because it does that. Then you want to wait for the currency pair to move from the third standard deviation Bollinger Band to the second standard deviation Bollinger Band. You want to look for a close. So basically, let's say we're rallying. Rather than just selling whenever it touches the third standard deviation Bollinger Band, you want the currency pair to roll over and then close outside or below, in this case, the second standard deviation Bollinger Band. So this kind of prevents us from taking these kind of bad trades here. Then, if you want for a higher probability trade, you can check to see if the ADX is less than 25, because that means that the strength of the trend is not that strong. So therefore, it may be a higher probability trade to take. So to make sure ADX is below 25, then you want to, in this case, sell at the open of the next candle. So we short here, stop at swing high or low, which is usually 15 or 20 pips because we're using a 15-minute chart, and then target 1 times risk and trail your stop, or you can use 2 times risk for a 2-to-1 risk-reward ratio. So let's look at, these are kind of examples here. So we went short here, 80.87. If we went for 1 times risk, we would have closed our position here, and if we went to 2 times risk, we would have closed our position here. This is another example on the long side. You want to wait for the currency pair to sell off. You want to wait for it to close at or below the third standard deviation Bollinger Band. Then you want it to roll over, close outside the second standard deviation Bollinger Band, go long, targeting either 1 times risk or 2 times risk. And let me just show you a live chart on this. I was kind of looking for, opportunities when it closed at or above the third standard deviation Bollinger Band. We don't have any of that in this scenario here. The first time we have it is pretty much right around this region here. So here we actually have some choppy trading. It closes at or below the Bollinger Band. Rallies a little bit, but, probably ends up stopping us out. Here's a nicer example where it basically closed at a Bollinger Band. We wait for it to rally. Oh, this one, we actually wouldn't have taken this trade because if we look down here at ADX 25 is down here, and this trade was actually when ADX was really high. ADX in this case was around somewhere around here above 30. So that is the reason why we use ADX, because it helps filter out these kind of bad trades. Here we have the currency pair close at or below the Bollinger Band and rolls over. In this case, when it rolls over, we do have ADX below 25. Then we probably short somewhere around here, and we have a nice turn in this currency. Here's another example, closes at or above the third standard deviation Bollinger Band. ADX is below 25, and then we basically enter at this candle here, going for the reversal. Let's move over to the euro-dollar chart. Let's do the pound-dollar to see if we have any examples in the pound-dollar, and then I'll move on after this example. So we're looking at live charts here. So here we have it close at or above the Bollinger Band, and then when here we basically sell here, and we sell here at around 154.93, and our stop is at the swing high here, 155.05. So basically, I would say it's about a 10 or 15 pip stop, and then we use a 10 or 15 pip first target. The low here is 154.75. We probably would have hit our first target.